In today's video, we're gonna talk about cash up front or cash flow. Which is better? What's gonna help you build a real future in your real estate investing business? What's going on, everybody? It's Jamel Gibbs, your family-oriented entrepreneur. Welcome to another video. On this channel, what we do is we teach real estate investors and entrepreneurs how to create time and freedom through proven real estate investing strategies. And that's exactly what we're going to talk about today. How to build real wealth, how to build cash flow or receive cash up front. Now, in this video series, I've walked you guys through the deal itself when I purchased this particular house. I also walk you through the rehab process. And in the last video, I had to make a decision if I was gonna sell a house, cash up front, or if I was gonna rent the house, cash flow. Well, in this video, I'm gonna reveal exactly what I decided to do. And at the end of the day, I think that this particular strategy that I decided to take on is gonna benefit me and my family long term. I've read your comments. Some of you guys were like, sell the house. Some of you guys were like, keep the house. One particular comment in general said, you're a smart guy, definitely keep the house. And that's exactly what I was thinking. I was thinking about keeping the house. But I will say this, I did play the market for a little bit. I did receive offers on the house. I decided to keep it long term. So I didn't list the property with a realtor, but I put it on the MLS. One quick tip for you guys is if you ever want to play the market and you don't want to pay 6% to a realtor to be able to sell your house, even 5%, what you can do is find a flat fee broker. That's how I list all of my houses. Flat fee brokerage, it cost me, I think it was like $100, maybe $200. And I offered 2.5% to any realtor that brought me offers if they would have sold the property. I ended up putting the property up for $140,000, which I thought was a really good price for this particular house. I got some feedback from some realtors. They said it was an excellent price for the house. We had several buyers come through, a lot of people interested in it. But at the end of the day, I thought that this property would be a good long-term investment for me to generate some cash flow. I bought this property for $73,000 back in October. We put $30,000 in remodeling this house, and we're all into this property after payments and interest and all of that stuff for about $105,000. I could easily sell this house today for $140,000 and make about a $35,000 profit. So I asked myself, does it make sense for me to take a $35,000 profit now and pay capital gains tax and pay more fees and things like that just to be able to accumulate the 35 grand? Or does it make more sense for me to keep the property, get tax benefits, get appreciation, cash flow, depreciation, things like that, just by keeping the property, okay? Now, my original budget on this house was around $12,000, $13,000 to get it from the stage that I was in to a rent-ready house, which was my initial strategy anyway. I wanted to rent the house. But I decided midway through the rehab to add more money into the house to be able to get it sale ready. Okay, I saw a house on the next street that sold for $160,000. It has another bedroom and another bathroom, so it's a slightly larger house. So it can command, you know, a $10,000, $20,000 increase in price. I could easily get $150,000 for this house. That one got $160,000. But I decided midway through the rehab to add more money into the property to be able to command, because I was gonna sell it. So I wanted to command a higher price for the property. So rather than me getting it rent ready, I was getting it sale ready. Now, one thing about getting a property rent ready versus sale ready, if you're gonna keep a property long term, you should probably consider putting more money into the property to get it sale ready anyway. because it's gonna show better and you're gonna have less problems long-term if you decide to keep the property, okay? So I ended up coming out of my pocket with actual cash on this deal in the amount of about $18,000 to $20,000, okay? So I had the money from my private money lender. I didn't want to get an increase from the private money lender. I decided that I wanted to pull out my own cash just for time purposes. It sped things up for me, and it just made sense. I'm all into this property after the loans and everything like that, about $105,000, but that's including my money. If we're only talking about lenders' money, then I'm only into this property for about $85,000. Now tomorrow, I'm actually gonna be refinancing this property. I'm gonna keep some money into the deal, and I'm gonna explain why I'm doing that. Number one, it helps me to keep my payment lower, so it creates more cash flow for me long term. And number two, I don't wanna pull all of my money out, because to me, having a house, if you think about it as a business, having a house is like having your own separate bank account, and the tenant that lives in the house is basically feeding your bank account every single month. So when you think about it from that standpoint, I'd rather keep some money in this deal, right? And I'd rather have the tenant pay down or feed my bank account, paying down my mortgage. And then every year, I'm expecting at least a 3% increase in appreciation on this property. So let's say in 3 to 5 years, I decided to sell it, I could get another $10,000 to $15,000 then to be able to max out my profit potential. All I'm doing is pulling out tax-free dollars. Rather than me refinancing and creating a higher payment on this property, I'm gonna keep the principal on the property, the principal, interest, taxes, and insurance relatively low, so I can cash flow more every single month. And then I'm gonna take a line of credit against the house. So if I use the line of credit, I'm only getting charged every single month on what I actually use from the line of credit, right? So if I refinance this house, it's gonna increase the payment. If I pull out a line of credit, it's not gonna stick long term. What's gonna happen is if I use, let's say, $20,000, I'll only pay on the $20,000 even if I got a $100,000 line of credit. So I got a valuation of $140,000. I'm only gonna be into the property after tomorrow for $95,000. After all said and done, the payments on this property is gonna be around $700. I got a tenant, long-term tenant, fantastic tenant. I'll talk about that in just a minute, for $1,000 a month. Last week, I pulled the property off of the sale market and I put it up for rent. Within 2 hours, we had 80 people hit us up to try and rent this house. Number one, that told me that I definitely priced it too low. And number two, that told me that we could have got more money for this house. But I'm not mad, because I purposely wanted to price it a little on the lower side. We actually priced it 20% below the actual market rent in the area, but we're still gonna cash flow on the property long term. So it just makes sense for us to be able to do it. So the payments on this, after the principal and interest and everything, is gonna be about $700. We're gonna have $300 in pure cash flow coming in every single month off of this property. I'm gonna pull a line on this property for about 30 grand, right? So I'm just gonna move the money from this project into a larger project. So that's my long-term vision. That's the way I'm thinking about this house. Rather than me going out there and hustling up another 30, 40, 50 grand to purchase another house just like this, I'd rather let the property do the work. And that's the way I'm thinking about every single project going in. Do I need the money now, or do I wanna hold on to the money long-term, then be able to get a larger project by putting money together? On this property, we're gonna have, I think it's $50,000 to $60,000 in equity right off the bat. We're going to have $300 a month in cash flow. If this tenant ever decides to move out, give him a 1-year lease. If he ever decides to move out, I'll increase it a little bit, right? I'm getting $3,000 up front from the tenant, 2 months rent, 1 month security. So first and last month's rent, 1 month security, $1,000 each month. The tenant pays for water, sewer, everything. We don't pay for any utilities, which is fantastic as well. Now, the good thing about this tenant, the guy makes 8 times the money of what the rent is. Typically, you want to look for a tenant that's making at least 3 times the money of what the rent is. This tenant is making close to $8,000 a month. The rent here is only $1,000. He's a truck driver, really respectable guy. He actually reminds me of one of my uncles. I'm just looking forward to having him as a tenant. And long term, he is interested in purchasing. So when I'm ready to cash out, we'll discuss price and all of that stuff at that point. I use this app. I'll leave the app that I used in the description box to be able to facilitate the whole thing. This is what we do on all our rental properties. And it makes life much easier for me to be able to screen the tenants, to be able to provide a lease to the tenants. Everything is done through the app. It's all automated, and they send you a tax document at the end of every year. It works great if you have multiple rental properties. Definitely wanted to talk about what I decided to do, and I'm looking to hear your feedback on what you thought about the decision. Think about it. $300 a month is, what's 12 times 3? 36? $3,600 a year. If I just held on to this property for another 5 years, that's another, what, $15,000 to $20,000 in profit, where I could have took $35,000 up front. I'm making close to $18,000 on rent. Then that's not including the appreciation. On appreciation alone, on $140,000 as of today, times points, that's $4,200 a year. If I kept it for 5 more years, that's another $21,000. And that's not including the equity that we already have in the house, right? So we got $50,000 right now in the house. So if you do the math, $89,000. And that's not including the tax benefits. I didn't even talk about the depreciation, where we're gonna write off on our taxes every single year to be able to save money that way, right? So we're easily looking at over $100,000 in profit off of this property just for keeping it for 5 years, right? So what makes more sense? Let's do the math. Taking a $35,000, $40,000 payment up front, or making over $100,000 by spacing it out and keeping the property and benefiting from it long term. You tell me what makes more sense. And this is why I teach on this channel time and freedom. This is how you create real wealth. This is how you create that time and freedom. It's through passive income streams, right? It's through being able to wake up in the morning, not having to worry about where the next dollar is coming from, because you have cash flow coming in every single month. I hope you guys enjoyed this video. Leave a comment, like this video, subscribe to my channel, click the notification bell. I'm gonna see you guys on the next one. Peace.